Let's welcome in Saurabh Mukherjea, who's also joining us this morning. Saurabh, good to have you with us. Where are we at, Saurabh? You've been so optimistic this entire time, or optimistic and realistically, in the sense that you've been, looking for opportunities with a wider horizon going forward. Given that we still haven't really seen anything on the stimulus, we've already upped the borrowing. There are no revenues coming in. Companies, while some numbers do look a little shaky, the real impact will probably only be known, in the July results. Where do we stand now?
Still remember, I think I was on your channel when the market hit circuit down a couple of months ago, and suddenly I looked at my phone and realized how much some stocks had fallen. And I still remember, and apologies in a way belatedly, I ran out of the room to speak to my colleagues about buying some of the stocks which had fallen. From that day, when the market hit circuit down, and I remember that evening we did a call with our clients as well, telling them that we were very optimistic. I told you and your viewers on air that we were very optimistic. The market is up, I think, about 25% from that day. I think overall, the macro situation is a lot better than the kind of whole bleak forecasting industry would have you believe. To say that GDP is not going to grow this year is but obvious, right? We're going to lose April, May, most probably a big part of June as well. But the question is, can we rebuild this economy from August, September, October? And I think the answer there looks to be, basis what we are seeing in other countries, the answer looks to be almost an emphatic yes, right? So if you see across the world, whether you look at China, you look at Italy, you look at even other beaten down European economies, beaten down by COVID, the recovery post-lockdown ending seems to be pretty rapid. So two-wheeler demand, car demand, washing machine, fridges, Disneyland sellouts, Airbnb pickups, right? These are coming back very sharply once people come out of the lockdown. Now, I don't have full visibility on when India will emerge from the lockdown. It does look like the second half of the month we will start inching back towards going back to work. Perhaps not in Bombay, but the rest of the country does look likely will go back to work, and that would suggest then that from August onwards we will have a degree of normalcy in demand. If that is the case, if we're looking at a degree of normalcy returning to demand from August onwards, then almost certainly the stock market in its entirety is significantly undervalued, and specifically the sorts of stocks that we love to buy, a Bajaj Finance and HDFC Bank, Kotak Bank, stocks that I've advocated for a long time on your channel. I think they look incredibly juicy. They look incredibly attractive at these levels. I think this is the first time in my career, in my 12 years in India, I've seen HDFC Bank at these levels, and it looks very tasty. So overall market, if you're looking at a return to work by second half of May, normalcy in demand returns by July, August, overall market looks attractive. Specifically, high quality financials, the premium financial names in the NBFC world, the Bajaj and banking, HDFC, Kotak, HDFC Bank, Kotak, even the auto sector, right? Because we're getting strong data across the world that post-COVID lockdowns, auto demand roars back. So the auto sector, I would say, is probably looking the tastiest I've seen it in 5-6 years. So lots to look forward to. I know it's difficult to do this. It's difficult to look forward to stuff given that we are all locked up in our houses. But as I said that day when the market hit circuit down, look forward, look at the amount of global central bank liquidity that's been pumped in, look at the degree of foreign interest in India, both from an FPI and an FDI perspective. Don't get caught up in the here and now. Don't get caught up in the bleak forecasting community who are making forecasts which are but obvious, right? If you shut down the economy for 2 months, obviously you'll have weak GDP growth, but that's neither here nor there. What is the utility of those forecasts? I sort of fail to understand at this juncture.
Okay, Saurabh, so many points there. Let me pick up on, firstly, how you're finding those financials juicy and tasty. You're almost salivating at those prices, Saurabh. But what are you also making of Sanjeev Bajaj's comments coming in? He's actually said that, NBFC have asked RBIs for a separate line of liquidity, some kind of credit guarantee scheme, that they should be included in essentials just like banks, and talking about, of course, the stimulus and that the government can probably afford a 4 to 5% of GDP stimulus. What are you making of some of those comments coming in, and the fact that this is not the first time he has been speaking on behalf of the industry and really calling out for some measures from the government?
So let me just take it step by step. Why do I find a stock like Bajaj Finance, which is a big holding of ours, why do I find it incredibly attractive? In very simple terms, a stock price, any company stock price broadly discounts the next 20 years of profits, right? In very simple terms, any company stock price discounts the next 20 years of profits. Bajaj Finance is almost halved. That basically suggests that the market is implying that that Bajaj Finance won't make money for the next 7-8 years. That to me doesn't make any sense. Right? Why does it not make sense? If we look at the CP markets, the secondary yields in the CP markets, both on 3 months commercial paper and on 1 year commercial paper, Bajaj Finance alongside HDFC is trading at the lowest yields. It suggests that the money market feels very confident giving money to Bajaj Finance, right? Secondly, if I look at the liability franchise, 92% or a little bit more than 92% of the liabilities are locked in for 3 to 5 years. I.e., for 3 to 5 years, with the combination of bank loans from banks like HDFC Bank, Kotak Bank, and retail deposits from H&Ws, Bajaj Finance's liability franchise is properly locked down. They don't actually need that much money from the CP market. Now, coming on to Sanjeev Bajaj's comments vis-a-vis RBI line of funding. As a smart businessman, obviously he's playing from a position of strength, and he's urging the RBI to lower the cost of funding further for NBFCs. It's something that will help the whole industry, but it'll also help the market leader, Bajaj Finance, potentially disproportionately. Bajaj Finance, alongside HDFC, is now the unquestioned market leader in the NBFC world. They will benefit disproportionately from an RBI line of funding. Furthermore, from a macro standpoint, you can see the merits of his argument, because the RBI has tried TLTRO twice. By giving money to the banks, the RBI is saying, banks, please go and lend to the NBFCs. The banks are happy to lend to the premium NBFCs, Bajaj and HDFC, but the banks are simply refusing to go down the credit risk curve, because the banks are saying, RBI, you're not going to protect me from credit risk, so why should I lend to the weaker NBFC? And therefore, Sanjeev Bajaj's comment, the RBI needs to, in a way, circumvent the banks and lend directly to the NBFCs. To be fair to Sanjeev Bajaj, the other via media, which was mutual funds, are all but broken, right? You can't really, the mutual fund ecosystem has obviously suffered in the wake of the Templeton issues. So the only via media, the via media is gone, which is banks and mutual funds no longer functioning properly. Mr. Bajaj is asking the RBI to lend directly to the NBFCs. I don't know how quickly the RBI will accept that, but I think the 90-day moratorium getting extended to the NBFCs does look to be a high quality, the high probability event. So far, the RBI has desisted from extending the moratorium to NBFCs, i.e. NBFCs borrowings from the banks don't benefit from the moratorium. I think it's a matter of time before the NBFCs also get included in that moratorium. I think SBI itself has made an announcement, State Bank of India has made an announcement that it will give NBFC borrowers a moratorium. So I think the likely first step is NBFCs get a moratorium, and then 3 months out we might have to see whether 90-day moratorium for banks and NBFCs work, or should it be a 180-day. So there will be more relief from the RBI. Whether it will be of the precise sort Mr. Bajaj seeks or not, I don't know.
Okay, fair enough. Hi there, Saurabh. Let's get in your take on another sector that you said looks mouth-watering or juicy, and that was the auto space. Now, I know you're saying don't focus on near-term, focus on the long-term projections, but the fact of the matter is that even pre-COVID, this sector was going through quite a tough time, to put it mildly. A lot of industry voices from this space as well are saying that it's time to either pivot or perish. So if we don't see anything materialistically changing for the auto sector, what makes you bullish on prospects of the auto companies? And would you like to be a little bit more specific as to what within auto you like?
So look, I think if we just step back and look at what was holding back auto demand, one was the whole challenge around BS6, right? That's now behind us. Secondly, cost of borrowing for auto loans, whilst it wasn't high, it wasn't particularly cheap. I think the prospects that there will be RBI intervention on this front, I think, are quite high. If I look at the RBI's predicament, the RBI is doing TLTRO, giving money to the banks. The banks, in turn, are not lending it out. In fact, banks are coming back in the reverse repo and parking it with the RBI. So I think the logical step for the RBI to take will be, A, to turn around and say, hey, banks, you can't put so much money in the reverse repo window. It's not on. Secondly, I will give you relief right? Capital charge relief on SME loans and auto loans. I think that looks to be a high probability event rather than RBI saying, here's more TLTRO. I think a more logical way for the RBI to try to stimulate the economy is to say, I'll give you relief on capital charge on auto loans and on SME loans. Right? Therefore, it looks to me to be a relatively high probability event that the cost of auto loans from the banking sector should come down materially over the next 3, 4, 5 months. Alongside that, it's also likely that the auto companies, in order to offload inventory, will also be realistic about prices, right? And finally, on the demand side, the biggest demand push for the auto sector will be COVID itself, right? Anybody who can afford to buy a bike or a car, I think will do so. The desire to avoid public transport will be intense. And what we are seeing in many countries, right, and the data is coming through, is traffic jams go up post-COVID as more people choose to take to the roads to drive, right? Whether it's in China, we're seeing traffic jams up in China, traffic jams up in Western cities which are coming out of lockdown. Ironically, a lot of people are choosing to work from home post-COVID, understandable. But even then, cars on the road, bikes on the road is increasing because people are choosing to get personal transport for themselves rather than get on public transport. So COVID acts as the most, a bizarre demand stimulus for the auto sector. From a supply side perspective, the RBI, I think, will work to get cost of funds down for car loan and motorbike loan borrowers. And the industry, the auto industry, I think will be realistic about prices. I think it's a pretty high probability event, if you ask me, over the next 12 months, seeing a two-wheeler and a car demand recovery. Trucks is harder, but cars and two-wheelers, I think high probability event that we'll see a demand recovery.
Okay, fair enough. And what are you making of the kind of earnings that we've seen within the IT space? Are you seeking comfort in some of the other defenses like pharma too?
So look, our style of investing, in a way, you could call it, some will call it permanently defensive. Our style of investing is you permanently look for companies with great balance sheets, strong cash flows, powerful franchises, high ROCs. So in that context, we've had for a long time, had in our advisory portfolios, TCS. In the auto sector, we've had Eicher Motors in our portfolio for a good 9-10 months now. We've had, in the pharma sector, we've had Divi's Labs in our portfolio. So we'll carry on with that. We try not to sort of tilt the portfolio just because of exogenous circumstances. But I think the Indian IT sector generally, leaving not just TCS, but even Infosys, I think HCL Tech numbers have been solid. And given that America is in recession, it's highly likely America will go into cost-cutting mode over the next 12 months. If you're going to cut costs in America, the first phone numbers you'll ring are the Indian IT services companies. So without being specific about who will benefit how much, at this stage, my reckoning is the outlook for Indian IT services is pretty robust. The currency has given up good 9-10% of its value over the last 7-8 months. That also should help the sector maintain profitability. Yes, there'll be trouble getting H-1B visas, but when you hear both Infosys and TCS say that, a staggering number, 92% of staff are working from home successfully. Ironically, what relevance the H-1B visas have becomes actually quite questionable.
Saurabh, are you a little concerned about private banks at large? I know you talked about HDFC Bank being at prime valuations and it being an alarming buy. But just case in point being ICICI Bank's earnings, for instance, 30% of their corporate book has opted for moratorium. And the kind of COVID provisioning that they'll have to do, not just for the quarter gone by, but in the future quarters ahead as well. If there is no support coming in from the government for the MSME or the corporate sector at large, or for that matter, some relief for banks per se from the central bank itself, do you think then, we're looking at a very large issue staring at us?
I think it's worth realizing already something like 80% of the private sector banks' loans are accounted for by 4 banks, right? It's HDFC Bank, Kotak Bank, ICICI and Axis. So the other private sector banks put together barely 20-23% of the loans disbursed by private sector banks. So from a system perspective, from a systemic impact perspective, they have an impact. We saw what happened when Yes Bank went through its crisis. They have an impact, but from a macro perspective, from a GDP growth perspective, the impact is a little less. As I've said for the last couple of years, right, whether it's NBFCs, whether it's private banks, if you don't have access to CASA funding, which is a problem for all NBFCs and for most of the private sector banks with the four names, except the four names that I just mentioned, if you don't have access to stable CASA funding, you will have a challenge building a large loan book in India. So yes, barring these four large lenders that I mentioned, others do borrow in the CD market, and the NBFCs obviously rely on the CD market. But that is a fragile business model. And I think we're going to see a continuation of consolidation in the NBFC sector. In a way, the banks have already consolidated in terms of market share, but I think the smaller banks will find life getting progressively difficult as the year goes on ahead. What we've seen across the Indian economy, right, is sector after sector consolidates to two large players accounting for 80% of market share, right? And if I look at India over the last 20, 30 years, the data is quite staggering. India's top 20 PAT generators, India's top 20 profit generators now account for 70% of the profits generated by our whole country. This number was 15% in 1991. Now it's 70%. The top 20 profit generators, TCS, HDFC Bank, ITC, these behemoths now account for 70% of the profit generated by a whole country. And that trend, I think, continues. That will continue in the whole economy. It will continue in banking. It will continue in NBFCs. 2 to 3 NBFCs, 2 to 3 banks will end up driving 80% market share in both of these critical sectors for our economy.
Saurabh, the other puzzling thing in the market is what's happening with some of the staples or FMCG names. Unilever being a case in point, wherein the GSK block happened, we were debating about peak valuations in Unilever and the stock must correct from here. But just look at how the block got lapped up. I mean, it really leaves you to wonder whether it's going to be one of those DMart kind of stories, whether, however expensive the valuations may be, there'll always be a taker at whatever given price.
And I think this links exactly to my preceding point, right? If I am Unilever, if I am a Western private equity, if I am Western FDI, I know that this is the world's 6th largest economy. I also know that if I'm a top 20 profit generator in the world's 6th largest economy, I'll basically be in an incredibly powerful position, right? So the whole thrust of FPI and FDI money, the whole thrust on FPI and FDI money will be around getting a lock on the funding heights of the Indian economy. You'll want stakes in the top 2 or 3 Indian banks. You'll want stakes in the top 2 or 3 Indian NBFCs. You'll want stakes in the top couple of telecom players, so on and so forth, right? Paints, adhesives, various FMCG products, pharmaceuticals. That's the way the American economy has gone. And by the time our careers are done, the top 15 Indian companies will account for 80% of the country's profits, right? The rest of our careers, all of us should, and FPI, FDI investors should also focus on these top 15, 20 Indian stocks, right? This is the way free market economies evolve. This is the way Japan has evolved, Korea has evolved, the United States has evolved. And that's why whether it's Unilever and GSK, whether it is the whole drama playing out around Jio, where every week somebody's buying a stake, I think we will see plenty of FPI and FDI action in the year ahead. And that's why, again, I sort of exhorting your viewers, think about the structural play here. Think about the tectonic shift in global dynamics, where it's relatively clear to the Western economies that a young democracy like India has a lot to offer, and a country like ours whose our comparative advantage is knowledge, whether it's knowledge via pharma, knowledge via IT, knowledge via banking services, knowledge-oriented Indian businesses will be actively sought after by the world's largest investors.
Saurabh, good to have you on the show, and stay safe. We'll see you on the other side of COVID. Holding up pretty okay, about a 1% uptick is what you've seen, and we've latched on to it. In fact, build on further. We're back at 9,400 levels.